All right. All right. I'm going to do a little overview of buying and selling the stock option. Buying the stock option and then selling it, putting in a trail stop so that you guys get a better understanding or feel. And this is your homework to get this process down. And then next week, I want you to trade on a simulated account just to get the process down, and then you could be more fluent and get quicker. You know, practice makes perfect. So I could show you how to do this 100 times, but if you're not doing it on your end, it's probably not going to help you as much, because this is something that takes time to get this process down. So first and foremost, you're going to load up your Thinkorswim. This is the simulated side, the platform for you guys that are still taking trades on SPY. This is still moving. You guys can follow these two charts. For the people that are learning to do the stock options, I need your attention over here to the right-hand side. So when you upload your TOS platform, you're gonna see your charts here, and you can configure it however you want. But this training video specifically is going to go towards how to buy the stock option and sell out of the stock option. So what we're going to do is every morning when we come in here, we go over here to our trade tab. We're going to click trade tab, and you're going to see all this this craziness that is very simple once you understand it. And we're going to go through a walkthrough, a little breakdown of everything here. And you should, at the end of this, you should have a better understanding of what everything is here. So when you have all these different dates, you can press this arrow and a drop down will come down. And what this means is when you trade a stock option, these are all different expirations. So when we trade SPY in our room, we trade same day. So we're going to come to where it says 0, and that means that March 12th, today is March 12th. That means at 4:15 p.m. Eastern time, these contracts will they basically all expire or worthless unless you're in the money. You're going to see the contracts that have less time, this 0. So these numbers right here, you see where it says days until last trading day? These are all the expiration days. So how a stock option works is that the closest date, the smaller the number, they're going to be the cheapest. And the bigger this number gets, days until expiration, essentially you're buying time, the more days that you give it, the more expensive the options cost. So basically how this works is the more time you have on a stock option, the more money it's going to cost, because technically you're giving yourself the safety net as far as giving yourself all those days for the stock to work and move in your favor. So when we day trade though, we are quick scalpers. So that's why we trade same day expiration, and we also go to same week expiration. So if you trade an asset like Apple, you have every 7 days, every Friday, they have an expiration day. So we're going to go back here to SPY because that's typically what we trade. And we're going to click same day. So we have this open up right here. Now we're going to go in here, and I like personally a couple different things set up. I like to change the strikes from 4. I like to put 50 so I can see many different options. I also come up here to the layouts right here, and you click this little down tab right here, and you click this right here, and we're going to change a couple things. You come down here to customize, and once again, you can do whatever you want. This is just what I like on my end. So I come down here. I like to have the bid. We're going to clear all these. Remove. I like to have the bid, the ask. I keep scrolling down here. I like the delta. I like the open interest. Keep scrolling down here. And I like the volume. And these are just what I like personally on the day trading side. So then we come over here and you press OK. Now you're going to have, and let me try to spread this out a little bit. You're going to have, we'll put it right here. You're going to have your bid price, your ask price, your volume, your open interest, your delta. You got the bid size and the ask size. So when we trade stock options, first rule of thumb, when we trade SPY, we have a sweet spot. We like to trade the contract amount to be 80 cents to $2. So how do you determine what stock option that you trade, and what does all this mean? So our next step, we're going to come down in here too. This is Option Chain Basic 101. I changed my strikes to 50. So if you come down here and you see strike and you go straight down, you're going to see a different number, 373, 74, 75. You come down here, you see 395, 396, 397. How I personally view all these strikes is I look at them like bags of chips or a gallon of milk. So like every single one of these numbers is a different product, bag of chips we're going to say today. So every number is a different bag of chips. And what number, what bag of chips do you buy to give you that sweet spot in order for you to be profitable if it goes in your favor, but also while risking the least amount? So first and foremost, we have the strikes that are individually like bags of chips. Then our next thing, we come over here. On this left side, you see where it says calls right here. A call means that you come up here to the share price, and that share price goes higher than what the call option that you bought, we make money. So if you buy a call and the share price goes down in value, you're going to lose money. In flip script, if calls, you get paid when they go up in money. You come over here and you see the right-hand side is puts. So when we take a put and the share price moves up in value, we lose money. But if the share price falls down in value, we actually gain money. And that's why I share with a lot of people why I personally like to trade the stock option over the shares, because a lot of people have the 401k accounts, and in a down market, they get hammered. But when we trade a stock option and we grab puts, and our stock or our asset that we buy goes down in value, we actually make money. So a good thing to have is if you're long shares and then we start going into a start of a bear market, and we have tools that give us heads up in our live chat room, we go into a bear market, you could buy puts. So instead of your account losing money, your account might stay flat because you're going to lose money on the share side, but in return, you'll gain money on the put side. So then when you get that next leg back up, you're going to be able to you'll be able to sell for your account will be in real good profits, you know. So back to the option side, left side is calls, right side is puts. Now you see these purple shaded box, they're shaded purple, and then you got this black box. When it's purple, these strikes, these bag of chips on the call side are in the money. And then when you go over here to the puts, you have these bag of chips that are considered out of the money. So on the call side, you got in the money calls and you have out of the money calls. On the put side, you have out of the money puts, and you also have in the money puts. Now, what makes something in the money versus out of the money? Great question you would ask. So if calls are determined if the price moves up, if you come to the 392 bag of chips, our box is now purple, and this can change. So if you come up here to our share price, if the share price is 392 and higher, that 392 call will be shaded and considered in the money. If this share price drops to 391.99, this box will not be purple no more. It'll turn black like this. So the reason this 392.50 is black here is because it's out of the money. And how do we determine that? Once again, we go up here to the share price, and is 392.14 below 392.50? Absolutely it is. You know, so that is why this 392.50 is considered out of the money right now. So if the market starts trending up, and if the market starts trending up and we get above 392.50 and 392.51 on the share side, this bag of chips, the 392.50 calls, will now be in the purple. So that is how we get a contract that is in the money versus out of the money. And in regards, we flip over here to the put side. Why are all these puts not highlighted? These are all out of the money. Why? Because if we make money going down on the puts, the price of the share has to fall down. So the 392 is considered out of the money, because the share price is 392.18. That 392 puts, or the 392 puts, aka the bag of chips, if we would see on the share price 391.99, this purple would then shade up here, and now this would be considered in the money, right? So that is a basic interpretation as far as what, when people say in the money or out of the money, that's exactly what they mean. So 3 common terms that you might hear, you would hear people say out of the money, at the money, or in the money. In the money is ITM, in the money. At the money is ATM, at the money, abbreviation. And out of the money is OTM, out the money, abbreviation. So if you go into these groups or the Discords, you hear people say, I'm taking an in the money call, or I'm taking an out of the money put, or in the money put. That just kind of hopefully gives you a better understanding of what exactly they're talking about. So next term, we talked over the different bag of chips. You now understand why this box is purple and this is black. You understand out of the money. You understand in the money. You also understand at the money. And the same side on the calls would be the same thing on the puts. This is out of the money. This is in the money. And this is at the money. 3 terms. Now we go up here and see what all these numbers actually mean. So for each bag of chips, you go to the store and they're a different price. So how the market makes money, and this is what we understand, what we're paying for the bag of chips. All these bag of chips, they have different prices that you pay for. If you're buying a bag of chips that's in the money, you're going to pay more than something that's out of the money. So if you buy something that's in the money, you have more protection on your side, and you have a higher probability, technically, to get a winning trade out of that. You know, doesn't mean you can't win out of the money, but you'll understand why going out of the money isn't always the best thing. But sometimes going in the money isn't the best thing either. And we're going to cover that next. So how do we determine what option price calls, what it costs for us to buy that? So we're going to come up here to these terms over here. You see the bid and the ask. The bid is they're a floating price. The bid is the price, and the ask is the price. The difference between the bid and the ask is the spread. So there's any option you buy, there's always going to be a difference between the bid and the ask. And the reason that is because the difference between the bid and the ask, that's how the broker makes some of their money, also as part of commission. So there's always a fee for you to pay for taking a stock option trade, right? So how do we determine what we pay for out of our pocket? The bid and the ask are recorded in cents. So basically what you do is you see how this says 0.78. You come down here. Let me get my calculator real quick. So if you put in 0.78 and you times it by 100, that right there is what you pay for one contract, $78, right? So you basically take, I don't know why they do this. I don't know why they just don't put like a 79 and 82. And these prices will always fluctuate because if you come over to the SPY chart, every single candle you see, the price right here is always moving. You see the share price? It never stays flat. You have buyers that push the price up, and you got sellers that push the price down. So the stock will never stay the same, at least on SPY anyway. It'll never stay the same for the whole day. You see the difference from this point right here. It went from 392.59 and fell all the way down here to 391.20. So at this point, people took profits or they shorted this stock and they pushed it down. That's why the price fell. And then down here, buyers stepped in and pushed the price back up. So you have people that do this all day long, you know, and in our live room, if you're interested in that, you get to come see what we do daily. We try to get our 2 to 3 winning trades. Back to the stock option basics. Our bid and ask are 2 different prices that we pay, right? So if something is 85 cents, you times that by 100, that is $85. If you get filled on the ask, which we'll touch base on next when we take the actual trade, you will see the difference between the bid and the ask. So like when you market order into a trade, you always pay the higher amount, and that's just the difference. So technically, every time you take a trade, you're technically down 1 cent every single time, or 2 cents, one trading SPY. When you trade another asset like Amazon, I don't market order in, and I'm going to show you exactly why. You see the difference here of the bid and the ask? $1,220 and $1,270. If you market order in right away, you're automatically down $50, because if you market order into the trade, you pay the ask, but if you market order out of the trade, you get filled at the bid. So if you buy in right now at 1,235 and you sell immediately, you just lost about $65, $70. So that's why price has to move in your favor just a little bit for you to technically be break even at that point. But that's Amazon. We're going to go back to SPY again because that's what we trade every single day. So the bid and the ask are the prices of the options, right? And if you remember from the beginning, I share with my team, you should be buying options. The sweet spot to me is 80 cents to $2. So that means for every one contract you buy, you're paying 80 cents to $200. And I'm gonna explain to you shortly after this. So like, the next thing we go over is the volume right here. You got the volume. This means that there's this much people taking actions in these specific contracts, right? It doesn't mean today. It just means these contracts, people could have been at this area 2 or 3 weeks ago, 4 weeks ago. This is the total amount of action at this time. The open interest is the next channel that we have. The next spot that I like to see. To me, the open interest to me means that I need to see at least 100 people there, and this is why. If you take a position that has 2 open interests and you try to exit the position, you may not be able to get out of the trade. So I only like to trade stocks that is liquid, that I know could get me in the trade and out the trade. So the open interest to me is an easy way to look at that is how many people are at the party. If you got 100 people in the party and you walk into the party, are you going to be able to leave the party unnoticed? Absolutely. If you got 10,000 people at the party, are you going to be able to walk into the party? And then are you going to be able to walk out real easily without being noticed? Absolutely. So the higher number the open interest is, the better it is. But as long as it's above 100, then you'll be all right. You'll be able to get out of that trade, no problem. So that's the real basic version of what the open interest means to me and how I view it. Then we go to the next. Area. We have the delta. The delta is what is how you can calculate what your contract, that the bag of chips that you buy over here, the strike, whatever contract you buy, whether it's the calls or the puts, your delta is how you can guesstimate how much money you're going to make on that specific bag of chips or that specific strike as far as the stock option side. So if our delta is 42 cents, what that means is that for the share price, for every dollar the share price moves in your favor, you'll make 42 cents. Now it's 45. Now it's 48 because it's moving up. So as price moves in your favor, this delta will go up. So this is just like a rough estimate of what you're going to make, but you can always make more, because there's also other terms that go into the regards. If we get a strong up move, we get something that's called IV hike, and that's kind of a little different talk. So the delta gives us an estimation of how much we're going to make. So that right there, the delta, the open interest, the volume, the bid, and the ask are basically all 5 things that you really need to understand when taking trades with us in our chat room, right? So now you know what the strike is, what it means. You understand the bid, the ask, what you're paying. You understand the volume, the open interest, how many people are at the party. And now you understand the delta, and that is basically how much you're going to make or lose if the stock goes $1 in your favor or $1 against you, not in your favor, right? So at the beginning of this, why don't we take trades that the farther out of the money because they're cheaper? In the beginning, I've shared with you that not all contracts to me are beneficial for you to trade, and I'm going to share something with you right now. So if you buy the $3.99 calls, right? Let's see if it matches our criteria. Is it above 80 cents? No, it's not. It's 1 cent. Meaning that if you take 1 and you times it by 100, it's going to be, you're going to pay, you'll pay what? $1 for this one. So you put in 0.01 times 100, you pay $1 for this contract. So why not load up a whole bunch of these contracts, right? Well, look here. You need to get a whole dollar move for you to make 1 cent. Now, keep in mind, you have commissions to pay. You also have a spread. So if you market order into this trade for 2 cents and it moves up 1 whole penny, now your 2 cents is worth 3 cents. Well, guess what? You're 1 cent in profit. Well, also remember, when you trade the stock option side, your 1 cent is always to cover your commissions. So technically, when you go far out of the money, you see how hard it is when your delta is so low for you to make money. And that's where people's misled. They say, oh, there's 52,000 people at the party. There's 12,000 volume. And I can get 100 contracts. I can get 100 contracts for $100, right? That's not always the best case because look how little your delta is. Burst, right? Hear me out. You come up here and you buy the 392 calls for $1.03, and for every dollar it moves in your favor, you're now making $53, right? So that means that if the share price moves from 392.12 to 393.12, you just made $52 or $53, right? So now if you come over here to a chart on SPY, we'll do this example. If you bought in one of our signals right here at 393.33, and we put a stop out down here, and we put a 1-to-1, we'll say right here, look at the distance the share price moved. It moved 32 cents up here to 72 cents. So 72 cents minus 32 cents is 40 cents. So 40 cents of the share movement, we're going to get 40% of our delta. So if you take 54 cents and times it, 54 times 30, what did we say? 40%, right? Was it 40? Hold on. 32, 42, 52, 62. Yeah, 40. If you take, if you times it by 30, I'm sorry, 40%, you just made 40 cents on there. I don't know what I did. 54 times 40% equals 40 cents you just made. So if you go to your delta's at 55 cents. This little move right here gave you 40 cents or $40 profit on one contract. So if you risked $111 and this move right here would have generated you $40, you now just made $40 divided by 115. You just now made 34% ROI. Go to your bank and tell them that you trade with Beast Mode, and in from 11:38 until 11:52, right? Because we got the time right down here, 11:52 to 48. That is, or 38. That is 14 minutes. You just made 34% in 15 minutes. The bank doesn't even pay you 1% for a whole year. You guys catch the drift right now? So that's why you don't want to go all the way out here, because if you go far out of the money, right, and you took this same trade, you wouldn't even win 1 cent. You guys see that? Because your delta is so low. So what they do is they make all these contracts and they make them cheap because they bait people in with small accounts, thinking like, oh, well, if I have a $1,000 account and Brandon's only trading with 3% of his account, I can only risk $30 per trade. Well, the same thing for right here. I mean, this is a little better. If you buy one contract for $26 and we got this same example, what's 40% of 21? You're only going to make about $9 profit or $10 profit, you know, on $26. So that's a 50% ROI winner. So that's even higher from an ROI standpoint than trading at the money. And that's why people get baited in, because they look at the ROI standpoint, but it's harder to make money the farther out of the money you go, right? So that is why we have a sweet spot, 80 cents to $2 a contract. So I like to be as close to $1.50 as I can. So like right now, if I would trade, I will take the 391 calls, and they'll be for $1.80. So I pay $180. My delta is 70 cents. And if I get 40% of that, I'm making 30 cents for the same exact move right there. So in return, I would lose 30 cents or $30 on this trade. So if you had a $1,000 account, you could essentially take this trade, one contract for $180. You're basically going to win about 30, 35 bucks, and you're going to lose 30 to 35 bucks. When you pair that in with our Beast Mode butter day trading system, we have about a 80% probability over the long haul. Not the day, not the week, over the long haul, right? Does that make sense so far? So now we're going to go into how to execute the trade and what you should be doing. So now you understand the strike price, you understand the bid and the ask, you understand the volume, you understand the open interest, you understand the delta. Now, how do you make a trade, right? Great question. So what we're going to do is you can click real easy on TOS, you can click the bid and your order will populate, or you can click the ask. If you click the ask and you see how it's green, right? And we are in a simulated account, so it's technically not a real trade. This is just a teaching lesson of how to do this. Just to give you guys a better understanding of how to execute the options. Just remember, because I had people do this. If you click on the bid, it's going to be red. So you're selling this. You did not want to sell the stock option when you day trade with my strategy. We do sell options, but that's a whole different ballpark and animal that we could cover at a different topic. So when you go in here, always click the ask on the calls. And if you want to buy the puts, you click the ask on the puts. If you click down here and that box is red, you do not want that, right? So in this situation, since we were looking for calls, we're bullish. Bullish is a term of meaning that the market's going up. Bearish is a term that the market's going down. If you're bullish, you're going to get your calls loaded up. So we go up here and let's see what meets our criteria. We can take, is this higher than 80 cents? Yup. Is this higher than 80 cents? Yup. Is this one higher than 80 cents? Yup. Is this one higher than $2? Yes, it is. So that's too far in the money. I'll go back down and I will trade both of these. Either of these are acceptable to trade, and so is this one. If you have a smaller account, you could trade this. If you have a little bigger account, you could trade that one as well. Just know that the more expensive contract you make or you buy, the more on the option side that you're going to win as far as the cents, like on the delta, because look at our delta's higher. So we come in here, we make sure we see the spread is single. We want to buy. We do not want to sell. We want to buy. And if you're newer, let me see. I don't know why that's. Let me drag this real quick. I don't know why it's not letting me drag this. Hold on. There we go. All right. So you see right here, we're at 10. We're going to go to one contract. So if you're a beginner, you should start off always trading one contract, right? And you make sure this box is green. The symbol is SPY. The expiration is March 12th because we're day trading this. March 12th. We do a 391 strike call, which is right here. 391 call. Still's under $2. So that's a good. Then you come over here to the price. Then your order type, you change to market when we trade SPY, right? If you swing trade, you want to trade a limit. So if we put a limit in, it's going to give us the option to change our price. So if you come down here and you see the mids $1.85 and the ask is $1.95, I'm sorry, $1.89, you want to get the ask will fill you, and that's what the market order does for you automatically. So when we day trade, I like to do the market. So you press confirm, you click this button right here, right? You press confirm, send, and then another box will populate. You are not in the trade yet. So then you press send. Now, guess what? Guess what, guys? We're in the trade. You see where it says POS right here? So we're in this trade right now. So how do you get out of the trade? You right-click over this position, or you can come down here to your positions. You right-click over this position. You create a closing order. This one, you're selling it. Now our box should be red because we want to sell what we bought. You can press market order again, and guess what? Confirm send. We're not out of the trade yet. Now we press send. Guess what? We're out of that trade. We are no longer in a call, right? So next step. Now you guys understand how to buy a stock option. And now we're going to go to the next step of what I do when I take a trade. So what I do in the mornings is, since we're in a bullish trend right now. I'd only be looking to take the calls. So what I do is I click the ask, I press single, I change this. Normally it's at 10, but I'm gonna change it to 1 for teaching purposes. We go to market, you press confirm send, you leave this box sitting here. So what I do is I come over here and I wait. So let's just say right now, all right, guys, I'm going in SPY calls. I press send because we got that signal. I'm in a trade. I immediately go to this trade, create a closing order, and then I change it from market limit. I go to trail stop. I change the trail stop to 5 cents. Press confirm send. I let this box just sit here. So now what I'm doing is I'm waiting for a SPY to move in my direction. And once it hits my desired target, I then initiate my trail stop. So from a simulated side, let's see if it breaks this right here. If it breaks 45 cents, we're going to initiate our trail stop. So it could not break it, but if it does, we're going to initiate it. And we're going to pretend that it hit our 1-to-1. So if we clear these lines, clear drawing sets, if it hits this line right here, we're going to be good. Let me get back up our paper trade. So this box is still open. We're not in a trail stop yet. If it hits this line, or if it hits this line, whatever line it hits first, we're going to initiate our trail just for teaching purposes. This box is still open. I'm still watching this on my other monitor. Oh, guys, it's at our target. I'm going in a trail stop. Now, guess what? I'm in a trail stop. I don't have to do nothing. So we just let it go. As this keeps moving up in price, our trail is going to allow us to make more money. So we're still in this trade right now. So instead of selling out right here, we're now in this trade capturing more movement and we're making more money. You do not have to do nothing. At this point, it is a risk-free trade, and this will confirm and this will disappear once you're out of the trade. So let's sit here and watch it. I mean, watch this be in a trade for like 25 minutes, but we'll see what happens. So we just sit here and be patiently. We don't have to do nothing. As price moves in our favor, we're good. Maybe I should have put like a 2-center just for simulating purposes. We'll see how it plays out. I'm out. See how it just sold me out? Price went up here.
It is, though? It's noon.
Price went up here, and then now price fell back down. So now we are risk-free in that position. We just made money, and we're done. So now, say we're looking for a put trade. You come over here to the puts. What do we like? 80 cents to $2. So you can do the 392.50s, the 393s, the 394s. You come over here, you click the ask, you change this limit to market, confirm send, and you wait until you get our proper signal. Second, we get a signal. All right, guys, I'm going in. I'm pressing send. I'm in this trade now. I immediately go to this trade, create a closing order. I change my order type to trail stop. And you're going to put in a 3-center this time. So you want it to be -3 cents. -4 cents, -5 cents. That's a 3-cent trail, 4-cent trail, or 5-cent trail. Oh, just hit our target. Confirm send. Ready? We got to press this again for us to confirm it. And now it just hit it. Confirm. Guess what? We're in a trail stop right now. You do not have to do anything else now. That position will execute your trade for you automatically, and you just got another winning trade. Right? And that's how we do our SPY trading in the mornings. I market order in, and then I trail stop out. I market order in, and then I trail stop out. I market order in, and then I trail stop out. So we're still in this trade. If price keeps falling, it's going to allow us to make more money instead of selling out immediately. Just keep in mind that these gains aren't realistic because we're in a simulated account. We did just make $10 and $3 on both those examples. So we are in a simulated account. I know that. This is just for teaching purposes, just so I can walk you guys through, right? Hey, Miss Jen Williams, you still with me?
Yeah.
How's this for you? Does everything make a little bit more sense now, or?
Yeah, it's perfect. Perfect.
What questions do you have?
None yet.
Awesome stuff. Yeah. So
Yeah,
basically,
you're doing pretty good. Oh, the one-to-one. What does that mean? What, you keep saying one-to-one. What is that?
all right. So the one-to-one is basically when I put these lines on the chart. One-to-one means that if you enter here at this middle line right here, right, and our target is right here at this line, and our stop loss is down here, one-to-one means that we're risking to lose one in order to make one, as far as a risk management standpoint.
Okay.
Right? So if we put up an example, right here, Beast Mode Butter, we're in a momentum shift to the upside. We take calls right here at this red line. You see the red line here?
Mm-hmm.
If we put a stop out right here, meaning that if the price closes below this line, then we come up here. If it closes below this line, if you're going to take a loss down here, then you need to hold this the same distance that this stop out is to our entry line would be right here where our profit target is. So you'd want to, if you're going to take a loss at this line, you want to hold this trade to as close to this line as possible instead of trail stop. So when we say your risk to reward of one-to-one, this is exactly what we mean right here. Our risk to reward is -1 in order to get a +1. So if we enter here and our stop loss is down here, this would be our take profit. And that is what you call a risk to reward of one-to-one. And when we say it's at our one-to-one, that's exactly what we mean, like our one-to-one target.
Okay.
Right? You follow me now? A little bit?
Yeah.
It's definitely a lot to take in, but so back to the option side. If we take swing trades, right? Let's walk through a swing trade because they're slightly different. So if we're going to take actually Coca-Cola today, KO. We're going to go out until probably May 21st. And what I do in these is, this isn't a good example because the bid and ask is tight. Let's say you see how the bid and ask is $211 and $216. What you can do is to take this trade, you can put limit and you can try to get filled in between the bid and the ask. So the mid price is 214. So if you take 216 minus 211, what's the difference of that? It's a 5-cent difference, right? You understand?
Mm-hmm.
So the mid price is exactly the middle price of the bid and the ask. So when I take a swing trade, I'll try to get filled at $2.15 or 14 cents. So then my limit order is set for 214. So then I press confirm send and we'll see if it fills me. And it may not. So that's a downfall. So if you market order in, you'll get filled immediately. But there's certain trades that you do not want to market order into. And let me see if I can pull up one. See, it's not filling me right now. You know, so that means that like the we'll see if it can fill me or not. And if it's not filling you, this is the downfall. You got to go back in here. You see how the ask just jumped up to 221? That's why it's not filling me. So now you got to go in here and replace your order and now put a new mid price in and try to get in at a cheaper price. Oh, now we're in. So now we're in a swing trade. So what this means is we have 70 days until expiration. That means that we got 28, 50, 56. We almost got 3 months of time. So that means we got 70 days until this thing expires. So that right there is, if you buy today's expiration, look how cheap this is, $4. And then if you go to the contract we just bought, they're $212. See the difference of what same day expiration would do and 70 days of time do?
Yeah.
If you go out even farther, say you go out 679 days, look what they cost now. They cost $425 a contract. But the farther amount on the swing trades you go out, you're safer because you have all that time on your side. You follow me?
Mm-hmm.
So look, we're already up $20 on this Coca-Cola call. So I'm just going to close it out because it's on the sim account. We'll trail stop it out. Same thing. Say we wake up Monday morning and we're in profits. We come down here, we change this out, put a 5-center in. Now I'm in a trail stop and I'll just let it go.
I know you can do that. Huh.
And the trail stop takes all your emotions out of the trade. So if it keeps ripping up, You don't have to do nothing. And if it retraces against you, your order will close you out of the trade automatically. And that's why I love the trail stops.
Hey, Brandon, can you show me how to do a trail stop again on TOS? I was looking at the charts, so I wasn't looking at the Zoom.
Yeah, not a problem. So when we go back to SPY, I'll do this again. We go back to SPY and we buy, we'll go today's contract. Say we're bullish right now. We're going to buy our calls. We'll buy the 391 calls. I'm going to walk you through again. We click the ask price. Hold on. I don't know why that did that. We click the ask price here, and our position is going to come up. You do not want to click the bid price, right? Because if you click the bid, you see how this turns red. That means you're going to sell the option. And I have a very good friend, Mark. He can show you. He's an expert option seller. I like to buy the options. He likes to sell them. So when you day trade with me, we buy the option and then we sell it back. So always make sure this is green. So I have some clients that very first started with us. They bought in red and they're like, why are we losing money? I'm like, show me what you did. I said, hey, you did it wrong. You did it wrong. So always make sure you click this ask price. This box is green. You press market order, confirm send. Guess what? We're in the trade right now. Then you you right click this position. This will come out, create a closing order, and now this will come up. You want the closing order to be red, right? Yep. You come over here to your order type. You change it from limit to trail stop, not trail stop limit to trail stop, right?
Oh, okay.
So you press trail stop. Now this will come. So we're trail stopping the mark, which is the bid and the ask price. So we're trail stopping in the middle. So if our contracts are at 181 on the bid and 184 on the ask, it's going to trail stop you from 182.50. So if we put in a 10-cent trail stop, it's going to put a 10-cent trail on this option side. So you take whatever that mid price is and subtract by 10. That's where your trail stop is right now. So you really don't want to put a trail stop in until you're in net profit. You know what I'm saying?
Okay.
And if you want to be safe and say you're walking away from a computer, you can put in a trail stop of 20 or 30 cents and give it enough wiggle room if you're really bullish on it, and then tighten it up as it goes in your favor. But when we day trade,
but it's absolute price, is not percentage though, correct?
Yeah, but this is the thing. You can change it to percent if you want. I like to trail the option price. So how I do it is I change it to 5 cents and I press confirm and send, right? And then I press send. I'm in a trail stop right now. Now I'm going to walk you through how to change the trail stop on a percent end if that's the route you want to take. You know what I'm saying?
Well, I'm thinking like for swings, like I'm thinking like that might be great, the percentage wise for swings versus like a cent or so, because you can get stopped out pretty fast holding it.
Well, this is the thing. Whether you do a percent or you do an option price, it's essentially the same thing theoretically, because if you buy a contract for $1 and it gaps up Monday and they're worth $2 a contract, you're up 100%. So if you put in a 25-cent trail in the option, that's the same thing as putting in a 25% trail stop. You follow me?
That's true, yeah.
So you do whatever you want to do, but I'll show you how to do that right now. So if we go over here to the put side, we'll buy a put trade. And we'll come in here and we'll press confirm. We'll market order in, confirm, send. We're in this trade now. You right-click this, create closing order. You come down here to an order type, change your order from limit to trail stop. And you see this little box right here next to the price. You change it. Now it's a stair step. Now it's a percent. You want it to be 10%. You change it to there's 5%. There's 10%. There's 20%.
Okay. And what does stair step mean? So like the more it goes up, it increases the trail stop?
The stair step is similar to like an ATR type thing where it'll stair step up with you. So it's similar to a trail stop. It's just the ATR trail stop is more like it keeps a calculation away from the candles at all times, versus a trail stop, how we do it, it trails off the option price. And the reason I like the option price is because if you get a move up like these 3 candles or 4 candles, you're going to get a lot of IV hike in your favor. So these contracts will jack up real fast and quick, versus if you do a trail stop on like the ATR side, you may gain 50%, and then trade sideways and then only be up 25% after it gets you out of that, after that gets you off of that ATR trail stop, as far as like if it consolidates here. You follow what I'm saying?
Okay, nice. I like that.
Does that make sense? So
Yeah.
I put a trail stop off the option because sometimes we get those corrupted moves straight up and down that we can get IV hike on our favor. So the last term I'm going to say on this is IV. So when you get a strong move up like this and you're in calls, you'll actually make more money. So that's why the delta is not 100% representation of what exactly you would make, because if it moves up like this example right here, 1, 2, 3, 4, you'll then get IV hike in your favor and you might actually win more. So like how I explain to people is like this. If you buy in right here for say $1, right? This went straight up and this may be worth $1.50 at this point right here. Now it consolidates and this may drop down to like 135 or something, or 140 right here. So now if it comes back up here again, it may be worth $1.50 again when you could have already taken your $1.50 and prices actually below it. Does that make sense?
Mm-hmm.
That's how IV works in our favor. So that's why we love when we get those those biddy pushes up. You know what I'm saying?
Yeah, I'm gonna start doing that more. For futures, I do trail stops automatically because I can just set them up because it's automatic stop once I enter. And then once I get a few points of profit, it goes to break even. And then I move it up trailing. But that's an absolute price, not options price. So, but TOS, I've never got it right. So that helps me a lot.
So real quick, again, we're in this position. We're going to close out of this position because we're still in it. We go to trail stop. I like the trail stop, the option itself, 5 cents. You can change this to whatever you want. If you want to give it a little more loose, go to 10 cents or 15 cents. You press confirm send, press send. You're now in a trail stop. So Ryan and Jen, does that give you guys a better understanding of how we buy and sell the stock option in the Beast Mode Trading chat room?
Yep.
Yeah, I've been following it through futures. When you say, down or up, I just press market order, sell or buy, and go with that. It takes me a second. I'm not as fast with you options entering yet.
Hey, I'm thinking about it. I've been doing this for 5 years now, so it's not something that you're going to be an expert overnight at. I can help accelerate your learning curve, but I can't give you my screen time. You know what I'm saying? So
yeah, I know.
Guys,
That's why I say I find my own ways to catch up on the same time.
You guys come in and follow the plan, and you have a very high probability to be green at the end of the week. But the problem is that if you're newer and you don't know how to do this, I hope this video can help you out of what we do. So for next week, next Monday coming in, Jen, I want you to open up your simulated account and I want you to trade one contract for a couple days until you feel confident enough. And then once you pass your homework assignment, you're going to go over to a live account and trade one contract. And in no time, you're going to be the next expert trader here at Beast Mode Trading.
Sure thing.
Awesome stuff. Well, I appreciate you guys. I thank you. I hope you guys learned something from this. And going forward, if you guys have any questions, comments, or concerns, reach on out. I am going to cut the recording right now. Thank you for your time. I appreciate you guys. Beast Mode out.